Hello everyone, welcome back to my YouTube channel. I believe we've gone far like in single entry. We've had like 2 examples already on single entry and incomplete records. Thank you to those that are engaging, liking and sharing. I really do appreciate you guys. Thank you guys so much. So I'm going to go on with the last example. Like, we're not done with single entry. We've not treated control accounts. In my introduction to the single entry, I mentioned something about control accounts, where you need to find your purchases, your sales, that's your total creditors, total debtors control account. So we're going to be doing something involving like that. So let me write the topic on the board. This is refusing to open. Hey. My marker is refusing to open. Okay. Again. Oh, why is this marker like this? So everyone, we're going to be talking about conversion of single entry into double entry system. This way, like I said, the control account, purchases, ledger control account, and total debtors control account. I just mixed them up. I meant to say total creditors control account and total debtors control account. So let's read something. Business organizations whose books are being kept under the single entry system may decide to improve the system of accounting by introducing a complete double entry system. It is possible for complete records to be reconstructed by applying the principles of double entry to the information available. For example, you can have, like, in your total debtors control account, you have receipts from customers, but you will not have drawings. So your drawings will become your balancing figure. You might also have every other thing except for receipts from customers. You make that balancing. So anything you are looking for, you can make it the balancing figures, because I'm sure they will give you what you'll be able to use to find what you're looking for. Okay. So in preparing final accounts from incomplete records, the following operations must be followed. You must prepare an opening statement of affairs to calculate the capital. That's what opening capital. You get analysis of the cash book. That's your receipt and payments accounts. Reconstruct those accounts. You know, your receipt and payments account, they follow the principle of like double entry. It's just like cash and bank, debit the receiver, credit the giver. It's like a cash book. Receipt and payments is like a cash book. Reconstruct those accounts are necessary to find figures not given in the question. Like I said, you reconstruct from the figures you are giving, or the balances you are giving, you'll be able to use it to find nothing. Get it? Analysis of purchase and sales control account to get both purchases and sales respectively. They are talking about the control account. Preparation of any other required working schedule, e.g. reconstruction of nominal accounts, preparation of trading profits. You know, after you've gotten your sales and your purchases, then you can proceed to like prepare your trading profit and loss account, and hence your balance sheet. So they are defining let me define statement of affairs. We've done this. Please, you guys, if you're just watching this video, please go back to my previous one. I've done 2 videos on single entry. I did part 1, part 2. You guys can check it out, so like you follow up what we're doing. Alright, so the definition of statement of affairs. This is a balance sheet with a list of assets and liabilities. The difference between the asset and liabilities will give the capital. Like in the previous example we did, the difference between our assets and liabilities for opening statement of affairs will give us our opening capital. Then the difference on the other hand for closing statement of affairs will get our closing capital. So it's like that. Now, analysis of the cash book. The cash book must be prepared from the information deduced from the pass book, pay-in slip. The cash book will appear thus. Alright guys, so let me write the formats for receipt and payment, because I haven't actually talked about it. So it might not be the general. Any other thing can be added to this thing, but just a draft. We actually know the format cash book. Get same thing, debit to the receiver, credit the giver. But let me just write all here. So let me write the format of receipt and payment. I don't even know why I'm writing this because this thing is just, this is like a cash book. So see what I'm talking about. I just want you guys to see what I'm saying. I'm writing this so you like see what I'm saying. It's a cash book. It's the same thing as a cash book. Your balance brought forward. Our Naira sign. Balance brought forward. You have X. Receipts. Here they wrote receipt from customers. So let's write receipt from customers. X. They didn't write much here. Drawings. Remember, I said this is not everything that is in the cash book. I'm just writing some that is in the cash book. Drawings. X. Expenses. Remember, this is in cash book. This is the receiving side. This is the giving side. Expenses. X. Fixed assets purchased. You guys remember that it's only in cash book that you can record all these fixed assets. Remember, like in profit and loss account, it's just the depreciation that will be there. This account makes provision for opening balances and assets. So fixed assets purchased. Suppliers. I'm sure this should be payment to suppliers. It's just through suppliers. I've done a lot on control accounts. So like control accounts is like the easiest accounts. Like once you just know your format, once you just know your format, you're good to go, because you just have it by heart, then you just start substituting. Unless when they bring up like some questions that I've not even seen in the format before. Because sometimes some examiners do that. You think you know everything, but when you go, you'll be like, where is this one from? Suppliers. Balance carried down. Balance brought down. Remember, for when you have balance carried down, you always have balance brought down. So this is just like a draft. Here we go. I just want to show you guys. Hope you can see it, because I'll be rubbing it off soon. So now they said the trick of the examiners is to give the value of cash received from customers and drawings will not be given. In this kind of situation, drawings must be treated as the balancing figure. See, like I said, when you have like figures, other figures, you make the one you are looking for, you make that one the balancing figure. And on the other hand, if the drawings were given but the receipt from debtors, that's customers, is not shown, the receipt from customers must be treated as the balancing figure. That is, you add your drawings, expenses, fixed assets, suppliers, and balance carried down together. Then you deduct your balance brought forward. Then you get your receipt from customers. You get the logic now. You add everything here, just the way we did in opening statement of affairs, that you add, they make your opening capital the balancing figure. You add everything here, subtract your balance brought forward, then you get a receipt from customers. So reconstruct the total debtor control and total creditor control accounts to calculate sales and purchases figures. All this thing is same thing over and over again. So let's move to an illustration. Yeah. Let's solve an illustration. Remember, I'm going to attach it again here. I'm going to attach it before. So let me remove off the board. Hey guys, please, I know I'm saying this. If you've not watched my part 1 and part 2, like, unless maybe you have an idea of single entry and you know single entry, but please, I would appreciate it if you can like watch my part 1 and part 2. This is the part 3. You get, we've done the introduction, we've done like 2 examples already. This one is the conversion of single entry to double entry, where the control accounts will be applied. We didn't have anything on control accounts in the previous examples. And also, if you don't know like control accounts, like you're not familiar with it, I also have a video. I think before the single entry video I started, the part one, I recorded the control accounts video, so please guys go engage. So in the question it said the following is the summary of cash book of Joe for the year ended 31st March 1995. Okay, this is the cash book. Balance brought forward 23,430. Cash from debtors, cash paid to creditors. This is just like the cash book. Okay, so these are our additional information. 1,494, 31,395. I think that's a 1 year period. Yeah. The stock, remember the 1,494 is your opening balance, while the 31,395 is your closing balance. So that means your opening stock is 5,006, while your closing stock is 3,004. You are required to prepare statement of affairs as at 1st of April 1994, your debtors and creditors control account, your trading profits and loss account, then your balance sheet. So you better be quick because this is going to be long. So let's start with the statement of affairs. Obviously, it's the opening statement of affairs I will start with. Let's get our. I don't think we need to prepare a closing statement of affairs. Let's go. Statement of affairs. Served as at 1st of April 1994. So for them to say 1st of April 1994, we know that it's opening capital, opening statement of affairs. What is like to turn off this stuff? So moving on, our debtors. Now remember, our capital now will be our balancing figure because it's the opening capital we're looking for. So that will be our balancing figure. So debtors. We can start from stock. That's our current. We don't have any fixed assets here, so we just move on to our current assets. I'm picking the figures from debtors is on the 1,494. Current assets. So debtors. Opening balance of debtors is what? 12,000. We're looking at the opening balance, so we're focusing on the one of 14/94. So debtors there is 12,020. Stock is 5,600. What else? Creditors is a liability. Creditors is a liability. Accrued salary is a liability. So prepaid rent 440. You can say rent prepaid 440. Then remember, we shouldn't forget something. Our cash. We have cash at the beginning. Our opening balance of cash. If in the cash book you see cash in the cash book, that balance brought forward. That balance brought forward is cash like, and you know cash is a current asset. So cash at the beginning. So we have cash at the beginning and we have cash at close. The cash at close is the balance carried down of 8,980, while our opening cash balance is 23,430. So we are going to write 23,430 cash. 23,430. I think that's all for this side. Alright. Yeah. Now to the liability side, we have creditors. Our creditors in the opening balance side is the one under 1,494 is 9,800. We all know the format for the statement of affairs. We've done it. We did this. Obviously, it's only the control account we've not done. So 9,800. Then accrued salaries. Normally, if it was just salary, it wouldn't be there. It's because of that accrued salary. That's why that accruals are liabilities. So something you're owing. So accrued salaries. accrued salaries are 4,200. So now, like we said, the capital now is our balancing figure. And when I was explaining just now, I said you add everything here plus the thing here. You add everything here, subtract these two from the total of this side. So our total for this side is what? 41,490. Balance it here too. 41,490. Now subtract this from this. That will give us 27,490. You add these two together, subtract it from 41,490. You have 27,490. So you get it. What we've gotten now, what we've ascertained now is our capital. Difference between these two sides is 27,490. So now we've gotten our opening capital. So the next thing, they said we should prepare our statement of affairs, and we've done our statement of affairs as at 1st April 1994. So this is ticked out. Now let's solve the next question. Let me rub off the board. So the next question now, the next one we're told to prepare is our total debtors and total creditors control accounts. So now, this is what, like I said, the formats for, you need to know the formats for your control account. It will be very easy for you. The purpose of preparing this control account for creditors, you'll be able to get your figure for purchases. This is coming up because we are going to prepare trading profit and loss accounts, and in your format for trading profit and loss account, you need to do opening stock, add purchases. So that purchases figure is necessary. So that's what you are going to ascertain in your total creditors or your purchases control account, purchase ledger control account. So let's start with total debtors control account. The format for it, I've already taught it. So let's go ahead. Total. I'm really glad that this is a video. If not, this board would have. So anyone like you're lost or maybe you're confused in anyone, you can like rewind. And also if you don't understand, you can ask questions. So I love control accounts, guys. So now you make use of your opening balances and your closing balances, then the cash from debtors. Like, you know where your cash from cash received from customers are. Your opening balance brought forward will be on your debit side. It's just like assets account, you have a debit balance. So you start your balance brought forward here. What's your balance brought forward for debtors? 12,020. You see it on that 1494. That first one is the balance brought forward, the beginning. Yes, this is like they're just telling you people that were owing you at the beginning. Do you get? That's the meaning of that balance brought forward. These debtors were owing at the beginning. Do you get? If you notice, there's another one, balance. Wait, let's go ahead first. Balance brought forward. 12,020. Those years are just to tell you the beginning and the ending period. You get? So 12,020. Now we'll go and look for if like what they said, like cash in your cash book. You see something like cash from debtors. In your format, you know where it's meant to be. It's meant to be on the credit side. Your cash received from debtors. That means during the year, this is what they paid. And that's how much. They paid 182,350. 182,350. Now our balance carried down will be the next thing. I like normally if I'm the one summing, I write balance before and balance carried down. Now I'm down. Balance carried down. Where are we getting it? We're getting it from the 31,395. Remember I told you the opening balances is the one of April 1st, 1994 and March 31st, 1995 is the closing one. So now to get the balance carried down, that's the people that were owing at the end of the year. They were just 9,880. So So now, the balancing figure now, what are we trying to get here? Our sales. If it was creditors, we know that it is purchases we're looking for. But total debtors control account is relating to sales, while total creditors is relating to purchases, like we said in our previous video. So now the summation of these two is 100 and which one is bigger? Okay, obviously this one. 192,230. 192,230. So now the difference between this and this will be your sales figure. Let me put it in bracket. The difference. So now this minus this is 180,210. We've solved our what? Second and a half question, because it said in the B part we said prepare your debtors and creditors control accounts. So now we've prepared our debtors accounts. Now let's prepare our creditors control account. I'm going to be rubbing it off. You should see it. This will be purchases. We're trying to find our purchases now. Earlier on we're trying to find our sales. Now we're trying to find our what? Purchases. You know, you can write this heading. You can write it as purchases ledger control accounts. If you don't want to write total creditors, you can either say total creditors control accounts / purchases ledger control account. The two of them are the same. Or the other for sales, now you can say sales ledger control account or total debtors control account. Those are the same thing. Any heading? Our opening balance here before was here. Now for purchases, balance brought forward. If you remember your format, opening balance for total creditors will be here. Closing here. Once you just see you know it. Once you just know where your balance brought forward is, the opposite will always be here. So your balance carried down will be it. And if your opening balance was here, your cash received or cash paid will be the other side. Now that your purchases is here, balance brought forward, balance carried down, cash. I think it will be cash paid to suppliers. I'll check the book. Let's solve it. Now we're going to the creditors figure. Before we're using the debtors figure, let's see it. Under creditors on April 1st, 1994, 9,800. Balance brought forward. Balance brought forward, that's people were owing at the beginning of the year. People were owing at the beginning of the year. That's 9,800. At the end was 10,510. That's March 31st, 1995. Balance carried down 10,510. Yeah. Now let's go to our cash book. Cash paid to creditors. This will write it as 110,560. So now the total, this one will obviously be bigger. The total of this is 121,070. Remember, I write it for the two sides. 121,070. Now, remember the difference between this and this will give us what? Will give us what? Our purchases. As you remember, I told you whatever you're trying to find will be your balancing figure. That's just the key. So now purchases. Purchases is what? 111,270. Okay, our tick is still here from the total debtors. So we still have our tick. We're done with B now. No longer 2.5. We're done with B. So the next one now is, guys, this is like one question or just one question that is taking all these processes. What we did was first just get our opening capital, then next thing we did now was our total debtors. Now we've done our total creditors. So now that we have our purchases and sales, we can now prepare our profit and loss accounts. Sales on the credit side, opening stock, add purchases, add carriage one. Though I don't think carriage one is in the question. So let's rub this one up and prepare our trading profit and loss account. Trading profit and loss account for the year ended 31st of March 19. I shortened it because of space, guys. I shortened it because of space. So now our stock, we still use that opening figure again. The one of April 1st 1994 will obviously be your opening stock, while the one of March 31st 1995 will be your closing stock. So that means our opening stock is 5,600, and then the first thing in the trading profit and loss account is your opening stock. Opening stock is 5,600. Now we know our purchases. What was our figure for purchases? Our figure for purchases, let me just go to this thing. Our figure for purchases was 111,270. That was what we just did. Now I forgot to write it. I should have written it somewhere. Add purchases 111,270. When you add it together, you have 116,870. Now remember, we have our sales. Let's just write our sales now. Sales is meant to be here. What was our figure? What did we get under our total debtors control account? We got our sales as, you can rewind it to quickly see, 180,210. That was what we got. In the normal trading profit and loss account that had full information, they would have given you less return inward. In purchases, you less return outward. That's closing stock. Our closing stock is what? 3,400. Remember the one on the March 31st 1995 under stock, that's our closing stock. 3,400. When you less it, 0, 7, 8 minus 4, 4, 3, 1, 1. 113,470. Next is sales minus, this will become now your cost of goods sold. This one is usually called COGAS, cost of goods available for sale. And this is cost of goods sold. You don't have any other figure, like any other additional information on it. So now, how do you get your gross profit? Your gross profit is sales minus cost of goods sold. So 180,210 minus 113,470 will give us our gross profit. 66,740 is our gross profit. Let's clean this working. So now that we know it, we can balance the two figures together. Total is 180, 210, 180, 210. Let me clean this thing to trading accounts, because profit and loss account will not fit here. Do you guys get what I mean? This is just a trading account. Profit and loss account will not fit. Let's drop off the board. Let's keep our gross profits in mind, because we are going to bring it down. It's only gross profit we need in our profit and loss account. Let's circle it here. 66,740. Let's clean this rest. P and L account. Let me just write P and L. P and L account is profit and loss account. I'm just shortening it because of space. So let's quickly bring down our gross profit. Now gross profit brought down 66,000. See it here. So what are the things in P and L account? This is always our revenue side, and this is our expenses side. So let's go to our cash book. Cash book given to us. You can see for cash book your expenses are on the credit side. So let's see it. Cash book to creditors, you can't put that in P and L. Salaries, yes. Postages, yes. General expenses, yes. Drawings, no. Rent, yes. So but this now will have additional information. So salaries now, let's be working it before we write their figures. Salaries in the cash book was what? 10,800. But let's, it's in P&L that makes provision for adjustments. Your additional information, remember, if you go to additional, you see some things like accrued salaries. So you have to take those things into consideration. So owings of, I just hope I'm able to explain this thing well. Salaries. For accrued salaries, you can see April 1st, 1994, 4,200. March 31st, 1995, that's the closing one. So now whenever you are, the rule of accruals and prepayment. For accruals, you add owings, you add accruals, right? And you less prepaid. But that's for that period, for the year, for that year ended. So the one now, you can't add the two of them. Like in the April 1st, 1994, that is owing of last year. You can't add owing of last year to this year. So what you are going to add is March 31st, 1995. You are going to less owings of last year. You add owing of this year. What's only concerned in P&L for the year ended 31st 3, it's just things of this year that you're going to be concerned with too. Owings of last year is you less it. Owing of this year, you add it. Same goes to prepaid. What's the rule? You less prepaid, right? Like I said, we only deal with those rules for a particular end of the year. For prepaid, you less prepaid of this year. You add prepaid of last year. You're just doing like the opposite. Do you get? You're just doing like the opposite. You add prepaid of last year, less prepaid of. You're only applying that add accruals and less prepayments for the year ended. The ones of the previous one, you do the opposite. I think I've made myself clear. You guys get? You add owings of this year, less owings of last year. Less prepaid of this year, add prepaid of last year. You just do the opposite. So let's move forward. So for salaries in cash book was 10,800. Salaries was 10,800. Now in the accrued salaries, like I said, you less owing of last year. So less accrued salary of 1994. What was it? 4,200. That will give you what? 6,600. Now you add owings of this year. Add owing of this year. This year's owing is what? Accrued salary under March 31st, 750. You add it. This is 750. 7,350. So this is what now you put here as your salary is 7,350. You guys see it? This is owing of 1995. So that rule applies to this year. We are preparing profit and loss account for 1995, not for 1994. If it was for 1994, then we'll add owings of 1994. Now postages under cash book is what? 2,400. You look, is there any additional information for postages? There's no additional information, so you write your postages like that. Let me clean this thing. You write your postages 2,400. Let's go to our expenses again. General expenses, is there any additional information? General expenses is 12,340. There's no additional information for it, so you write it to general 12,340. Which other additional information? Rent. Our rent is 5,700. Let's go to the additional information. We have prepaid rent. We have additional information. Like I said, you less prepaid of 1995, add prepaid of 1994. Let's do the workings. Rent. Our rent in the cash book is what? 5,700. This thing is a working. All this is working to be able to get the figure that will actually be in the P&L. Add prepaid of last year. Add prepaid of 1994. That's what? 440. less prepaid of this year. That's less prepaid of 1995. What's that? What's under it? 670. 70. That would be our figure for rent. Let me see. Yes, rent 5470. So now we've gotten it. Like I said, we're going to in this, like, a period of, oh my god, I'm so exhausted, like. But anyways, we're done with the expenses side. So what we're going to do now is on gross profit. Normally, if we had something like rental income or any other income that is not accrued, we have added it here on the profit side. But since we don't have any other income, we just do our gross profit minus, let me clean this solution. It will be gross profit minus our total expenses. We've gotten our sales and purchases from the total debtors and total creditors control account. So that's how we've been able to impute it here. You guys, wait, let's say hi to the TikTok people. Okay, moving on. So our balancing figure definitely will be 66,740. Now the difference between all of this, I don't have time for that, will be our net profit. Net profit now is the balancing figure. Net profit carried down. Once you add all of these and subtract it from this, you get 39,180. So now we've done our P&L account. I think we can tick this off now. Now what we're going to need now, an important something like figure we're going to need now, is this net profit, because now the next thing we're preparing is our balance sheet. So now let's clean this. Let's keep this in our minds. 39,180. Now the capital we're going to use is our opening capital, like the one we did in our statement of affairs as at 1st of April 1994. So our capital previously, if you can rewind, but I still have the figure here on this book, so you can rewind and check. It was 27,490. We got 27,490. Remember, add your net profits. What did we say our net profit was? 39,180. Well, if you go to the question, before we move to the net profit, you add your additional capital. Remember, in our cash book, there was an additional capital of 60,000 naira. So we have an additional capital, we need to add it. 60,000. That will give us, that will be 87,490. Now we can add our net profit. Add net profit. Let me add it. You have 126,670. It's still the same format. So what we just did, the only different thing now is normally we usually add net profit after your capital, but since we had additional capital, we did capital, then add additional capital, then add net profit. So the next thing, we have to list our drawings. Drawings is in the capital, the cash book. That's it. Drawings of 25,000. We have to list it from our net profits. So less drawings. That will be 101,670. Now our current asset. Remember, we don't have any fixed asset. We are going to use the closing balance of our current assets. In the balance stock for April 1st, 1994 and for March 31, 1995. Obviously, since the balance sheet and end of the year period, we're using March 31st. The only time you use all these opening figures is when you want to adjust your expenses and when you want to opening statement of affairs. That's when you use this beginning, that's this opening figures. So stock will be, that's your closing stock, 3,400, 31,395. You're under current assets. Closing stock, let me just write closing stock straight. That's the stock that you've not yet used, so it's still your assets. At the end of the period, this is the stock that still remained, 3,400. I think your debtors will be there. Yes, your debtors at the end was 9,880. Debtors are also current assets, remember. 9,880. We still have cash of 98,980. You can see it in the question. Balance carried down. That balance represents cash at close. Where they didn't write it, they just wrote balance carried down under the cash book. So 98,980. So now already prepaid. Remember, prepayments are also assets, guys. We paid in advance, so it's an asset to us. We've not enjoyed the benefits. At 670. So now current liabilities. Let's go to current liabilities. We have our creditors in the additional information. We use the one at the close, the March 31st, 1995. Remember, so 10,510. Credit 110. Accruals. Remember, you guys, accruals are liabilities. So accrued salary 750. The one at the end. Remember, accrued salaries. So now, again, this is where the 10. You have to make sure they all balance. This side must be equal to this side. So when you add these two together, 0, 1 plus 5, 260. Now we can add it easily to this. Let me do it here. 101,670 plus 11260. So this side we have 112,930. Let's see if we'll get the same thing here. You know what? I'll add everything together. I'm not separating. 98,980, 9,880, 3,400, 670. 2 plus 9, 11. We did it. You see it? Now it's equal. So now we're done with the question. And now I can see we're done with single entry. You guys, we've come to the end of single entry and incomplete records. So the next thing I'm going to be talking on is trial balance. That will be my next video. I'll make a video on trial balance. Please, you guys should help me share this video. I really need more audience. Please like, share, and subscribe. I hope you guys love my lecture. I'm trying my best. So yeah, bye.